of the credit default swap market, the estimate was that the dollar value of credit default swaps was probably $50 to $60 trillion worth of these policies had been written, so 4 times the GDP of the United States. And when the credit default swaps that those brilliant bozos at AIG had written on all these mortgage-backed securities wound up being credit default swaps they had to pay on, because when Sam defaults, right, then everybody gets in line over here at the Johnson Insurance Company and says, here's my credit default swap, I bet against her. I bet that she was going to fail and default. It's like betting on the don't pass line. That we all line up to give him our insurance policy and get paid out. He didn't have enough money to do so. And he says, uh-oh, I can't. I don't have enough money to pay off all these people. Well, if we let AIG fail, right, so one possibility is to say, well, that's capitalism for you, right? Suckers born every minute. The Johnson Insurance Company can't pay out, so we're going to let the Johnson Insurance Company fail, and all of you people who bought credit default swaps from him, joke's on you, right? That's one possibility. So we could have let all the people who bought the CDSs go down, except that, who was the first person to buy the credit default swap? The bank, the lender. The first credit default swap on this loan to Sam was purchased by the lender. And so the concern was that if the number one writer of credit default swaps, AIG, went down, if they failed, if they went bankrupt and failed, that then there would not be anybody to write credit default swaps for the lenders, and then the lenders, burdened by the asymmetric information problem, would no longer be willing to write loans. And that's where you get the bailout of AIG. It was a long answer to a short question. Was that your question? Oh, good. This time I actually answered the question. Last time I did actually answer the question. Yeah, Ethan.
So we're Fannie Mae, but also mortgage insurance.
I'm not as good on the answer to the Fannie and Freddie question. Fannie and Freddie were insuring, they were not offering credit default swaps because not every schmo could walk up and buy a credit default swap, but they were insuring against the initial default on that mortgage. Yeah.
What was the value of the mortgage-backed security? Was it the difference between the equity and the mortgage, and then did mortgage-backed securities take interest to the people who bought them?
Where's the value of the mortgage-backed securities come from? So yes, they pay interest. So if you buy a mortgage-backed security, you would get regular dividends, which was basically the interest payments. There was a very strong secondary market in these MBSs, and so you could resell your MBS if it went up in value. And they have value because it's my mortgage means I'm promising to make payments over the next 30 years, and that's what provides the value in the package. Yeah, Peter, got it. Yeah. Solvency issues, right? So when we talked about banking, we talked about illiquidity versus insolvency, and one of the big issues at the beginning of the 2007-2008 crisis was whether or not we're looking at insolvency or illiquidity on the part of the banks. Many of these mortgage-backed securities and many of these credit default swaps were assets on the balance sheets of individual banks. So banks, in the old days, in the boring 363 days of banking, banks would hold a mortgage, an individual's mortgage on their balance sheet as an asset. So they would have Ruby and Gordon Olney's, that's my parents, mortgage on their balance sheet for 30 years. In the world of mortgage-backed securities, the banks don't hold individual mortgages on their balance sheet. They give them to the bundler who bundles them together, chops them up into 1,000 pieces, and sells those pieces off. So some of the banks purchase these mortgage-backed securities and carry those on their balance sheet, assuming that these mortgage-backed securities are very, very secure, low default risk assets. The very beginnings of the financial crisis are in August of 2006. It's on my board. Wait, no, it's August 2006. When the European Central Bank, which is the Europe's equivalent of the Fed, says to its member banks, lots of the banks of Europe are carrying these American mortgage-backed securities on their balance sheet as assets, and you're carrying them as if they have a very low default risk, because that's what Moody's has told you. And therefore, you don't have to have very much capital, money, set aside against the possibility of default on this particular asset. We, your regulators, the European Central Bank, think that the Moody's people and the Americans are crazy, not in so many words, and that these mortgage-backed securities are not worth as much as the Americans say they are, and therefore we, the European Central Bank, say that our banks, the banks of Europe, need to have more funds set aside against the likelihood of default on these American mortgage-backed securities. That's the first in the war, and it's because it's the first time when somebody has said what a lot of people believe, which is these things stink. Right? So the European Central Bank has authority that regular schmoes don't have, to say these American mortgage-backed securities are not worth what we thought they were. Yeah, you're asking me, is that August 2006 or 2007? August 2006, 7. Okay, so yeah, that's August 2006. It's on my door. I should just look at my door before I come to class. It's when I'm at Tahoe. I remember that. It's during our August vacation at Tahoe. So I try not to be an economist when I'm on vacation at Tahoe, but that was one year when I couldn't afford it. All right. Now, see, this is what I said about how I love this stuff, and I can rattle on and on. All right. So all of this financial stuff has real effects. That is, it affects CIG, exports, imports. It has real effects. It has effects on spending. And it has effects on spending through these home equity lines of credit. So equity, we've talked about. Equity in your house is the difference between, I think we talked about it, is the difference between what your house could sell for, so the current price of comparable homes, and what you still owe on your mortgage. So if you have a $200,000 mortgage and you have a house that could sell for $300,000, then you have $100,000 in equity. One of the financial developments of the 1990s was the home equity line of credit becomes particularly important circa 2000 or so. And the home equity line of credit works this way. The bank, you go to the bank, you say, I own this house, here's my mortgage, I only owe $200,000 on my mortgage. My house right now, I looked on Zillow.com this morning, and my house is worth $300,000. The house across the street sold for $325 last weekend. And the banker says, wow, you have a lot of equity in your home, I'm going to give you a line of credit. A line of credit is sort of like when you get your credit card, and they say, you've got this maximum that you can use on your credit cards, you've got a $5,000 maximum on your credit card, or a $1,000 maximum on your credit card. They get students bigger. When I was a student, it was a $500 maximum, inflation. That's sort of like your line of credit. So it's a maximum amount you can borrow, you don't have to borrow the whole thing. So they give you a line of credit, a maximum amount you can borrow, and then you can take that money and you can borrow it from the bank and use it for whatever you want. So we have these are called home equity lines of credit, or HELOCs. We have a HELOC at the Bank of America, and I now have actually a smartphone that I know how to use. I could, while I'm standing here, I won't, but I could, while I'm standing here, go onto the Bank of America website, and if I put my glasses on and didn't talk while I was doing it and went really slow, I could transfer, at this point, like $60,000 from my home equity line of credit to my checking account in about that much time. So I could do it in seconds. And that's how a home equity, and then I can spend it on whatever I want, right? So you convince me that we all ought to go to Europe. I can't get you all there for $60,000, but I could buy a whole lot of tickets for $60,000, and I could do all that by the end of the hour. So you get this promise from the bank that you can use as much up to this amount, whatever your line of credit is. You can transfer the money online between your equity line of credit and your checking account. You can do it in seconds, and you can spend that money on whatever you want. That's a HELOC. Yep. When people say they're getting a second mortgage, what does that mean? So a second mortgage means that you have one loan on your house, your primary loan on your house, and you want to borrow additional money. A HELOC is a second mortgage, which a lot of people don't realize. So a HELOC is a second mortgage. With a HELOC, the collateral, remember we talked about collateral, the collateral that you're putting up in order to get this home equity line of credit is your house. So if you don't pay back your primary mortgage or you don't pay back your home equity line of credit, the lender can take your house, can foreclose on your house. A second mortgage is, broadly speaking, this is a second loan which has your house as collateral. So a HELOC is a subset of a second mortgage. There are other forms of second mortgages, but they're all basically loans that are secured by your house, and the lender has the second claim, not the first claim on your house if you default. The first lender has the first claim. Which means that people who took out these HELOCs and used it, for instance, to pay, I don't know, tuition and fees, to go to Berkeley, or to go to Europe, or to buy a car, or to do whatever it is they wanted to do, if they don't pay back the HELOC, they can lose their house. So you can get foreclosed on either because you don't pay back your original mortgage, or you can get foreclosed on and lose your house because you don't pay back the amount you borrowed with this line of credit, which was really easy to use because you can get the money by going on your smartphone and moving it instantaneously in your checking account and taking all your students to Europe. Yep. So the question is, are the foreclosures that happened during the downturn mostly from first or second mortgages? I don't know the answer. I know the answer is a mix, that some of them were second, some were first, but I don't know what the breakout is of first versus second. Yeah. Okay. So the articles, there's one article that's in your reader, which is the Mia and Sufi article that's in your reader, and then on the handout that we gave out on Thursday was also the article, Christina and David Wilmer, kind of a much shorter article for 134, and it was so nice and short that I attached it to the handout for last Thursday. And both of these are by Mia and Sufi, and they look at these HELOCs, and they look at the effect of the HELOCs, the home equity lines of credit, on who's using them and what difference does that make in terms of the behavior of the economy. They have a very fine level of data, so they have some of their work they're using county level data, some of their work they're using zip code level data. The article that was in your reader, they got data from the credit companies, and they have to protect anonymity, to protect identity, to ensure anonymity, there we go, that each observation is actually 5 households at once. So it's 5 households in each observation, just so they can't sort of go into the data and uncover and identify, ooh, I know which family this is, and identify individual families. What do we get? First off, this, I forget which art, oh I know, the ones that are square are from the Federal Reserve newsletter. First is to look at what happens to the amount of borrowing. So the first time we looked at debt-to-income ratios was looking at the 1920s and the rise in consumer borrowing in the 1920s, and we had a doubling of the debt-to-income ratio in the 1920s. Here again, in the 2000s, we have this big rise in the debt-to-income ratio. Not quite a doubling, so going from 1 point something to 2 point something, so it's close to a near doubling of the debt-to-income ratio over the last decade. The red line is the debt-to-assets ratio, so instead of dividing by amount of household income, you're dividing by the amount of household assets, which is going to include the value of the house. But the takeaway from this is that we had some increase going on over the previous 5 decades, and then an absolute soaring of the amount of consumer debt that was taken out in the first decade of the century. This is a graph, I can skip this, this is the graph I did on Thursday that showed that the increase in the amount of increase in the housing price depends upon the slope of the supply curve, that in regions in which the long-run supply curve is relatively elastic, so there was a lot of building that went on in response to the initial rise in housing prices. In those regions, you get, those elastic regions, you get a smaller increase in housing prices than you get in the regions in which the housing stock is inelastic, where there's not a lot of building in response to the rise of housing prices. In those regions, you get a much greater increase. So that's the stuff that we did in the graphs on Thursday. Depending upon the slope of your supply curve, that is how much additional building is possible in the region, what happens to overall housing prices. If there's not a lot of building that's possible, the Bay Area, housing prices go up more than in the areas where it's really easy to add another subdevelopment at the edge of the city. People used their home equity lines of credit and they borrowed against them. The estimates that Mia and Sufi have, oh, you know what, I was going to stop before I did this. Well, I'll do this and then I'll stop. The estimates that they have are that for every $100,000 that people's home price went up, they would borrow $25,000 of that. So if your house price went from $400,000 to $500,000, you would borrow $25,000 from the bank. In the days before home equity lines of credit, if your housing price went up, you didn't increase your borrowing because you didn't have any way to do it. If your housing price went up, you either stayed in your house and you said, wow, our house is worth a lot more than it used to be. Isn't that nice? What do you want to have for dinner, dear? Or you moved, you sold the house and moved, and that's how you took advantage of the rise in housing prices. So you cashed out. But there wasn't any way to borrow. There wasn't an easy way to borrow against the rise in housing prices before the development of these home equity lines of credit. With the establishment of these HELOCs, the home equity lines of credit, people start borrowing and spending the increase in housing prices. That's peachy so long as those increases in housing prices go on forever. But they didn't. So who was it that was borrowing? You know, economists are a funny bunch because economists always start with assumptions of perfect markets. And so when housing prices started going up and there were all these home equity lines of credit and people were borrowing against the home equity lines of credit, there were a lot of economists who said, well, that doesn't make any sense. People wouldn't be doing that because people should have been able, people can always obtain whatever credit is they want to obtain. So that's an assumption of perfect markets and the ability to obtain credit, that people are not credit constrained. In fact, in the real world that most of us live in, there are people who are credit constrained. That is, there are people who want to spend and want to borrow who are not able to get loans and therefore are not able to spend. There are people who have constraints in their ability to get credit. That is to say, they're credit constrained. Those tend to be people who have relatively high credit card use, so they have maxed out their credit cards, so they've already got $20,000 charged off against their credit card. And there are people that tend to have low FICO scores. So your FICO score is partly dependent upon how much of the credit that's available to you that you've used and how good you are at paying it back. So the more of your credit card limit that you're actually using, the lower your FICO score. If you've got a $5,000 credit limit and you've charged $4,800, you're going to have a lower FICO score than somebody who has a $5,000 limit and has charged only $300. So what Mia and Sufi find was that the people who are using these HELOCs are the people who appear to be credit constrained. They're people who are maxed out on their credit cards, or they have really high balances anyway on their credit cards. They're people who have relatively low FICO scores because they don't have a whole lot of available credit that they can tap into. They've already borrowed most of what they have available. Their outstanding loan is close to their limit. The graphs that they had in the article that you read look at, I went through in my head how to do this in terms of rows and columns. These graphs look at the rise in debt, and they're looking at, in each graph, we've got the inelastic versus the elastic. So remember that in the inelastic regions, and that's the blue lines, there's a big price increase. And in the elastic regions, there's a small price increase. Okay. So if you live in a region where the supply of housing is inelastic, housing prices go up a whole lot, which means home equity goes up a whole lot. If you live in the regions where the supply of housing is elastic and really respond to price incentives, then housing prices don't go up very much at all, and so equity doesn't go up very much at all. And so, not surprisingly, look on the left-hand one. In the upper left-hand corner, the people who live in the inelastic MSAs, that is the people who live in the regions, an MSA is a region, the people who live in the regions where the housing supply is inelastic, that is the people who live in the regions where housing prices go up a lot, those people really increase the amount that they borrow. So that's what this line here says. On the other hand, the people who live in regions in which the supply of houses is elastic, that is to say where there's a lot of building in response to price incentives, in those regions housing prices don't go up very much at all, and there's not very much increase in borrowing in those regions. That's what this red line here on the left says. The comparison between the left-hand column and the right-hand column. The comparison between the left-hand column and the right-hand column is looking at, do we have, on the left we've got low credit quality homeowners, that is we've got homeowners who have low FICO scores. They do not have very good credit histories. On the right we've got high credit quality, we've got people with high FICO scores, so these are the people who are getting 780s, 790s, 800s. In the regions in which people have low FICO scores, so they have bad credit histories, they're probably maxed out on their credit cards, those are the regions in which, when prices went up a lot, those people borrowed a lot. That's the left-hand picture. But if you were somebody who was not credit constrained, that's another way to look at this. The left-hand column is the families that were probably credit constrained. They're already maxing out their credit card use. The right-hand column shows the people who are not credit constrained. If you were a family who was credit constrained, you'd already maxed out your credit card, you're already using most of your credit, and you lived in a region where housing prices went up a lot, you tapped into that increase in equity in your house by using a home equity line of credit. So you're somebody who's credit constrained, you want to borrow but you can't get more lending, your house now soars in value, you run down to the bank, you get a HELOC, you've got a lot of money you can tap into, you transfer it from your home equity line to your checking account on your phone, and you go off and you go spend it. If you're somebody who's not credit constrained, you already have a $50,000 limit on your credit card, you're not using but $1,000 of that to begin with, you don't have any cause to run down and get a home equity line of credit because you already got all the credit you could possibly use. So if you're a high credit quality household, you're one on the right, you don't have any need to borrow against the equity in your home, at least not as much need, because you've already got credit cards and other things that you can tap into to get your loan. So for the not credit constrained households, there is some increase, this is an upward sloping line, there is some increase in the amount of debt held by the high credit quality, the not credit constrained households, but it's much less than the amount that's tapped into by the credit constrained households living in the regions where housing prices really go up. The bottom pictures say the same thing. Instead of using FICO score, the top is using FICO score, the bottom is using how much of your credit card max are you actually charging. So if you're a high credit card utilization, so if you've maxed out your credit cards, you're on the left-hand side, you're a credit constrained household. If you haven't used anywhere near the maximum amount that you can charge your credit cards for, you're on the right. If you're credit constrained and housing prices went up a lot, you got yourself a home equity line of credit and you borrow against it. If you're not credit constrained, then it didn't matter whether you were living in a place where housing prices went up a lot or housing prices didn't go up much at all. Yeah. Are the interest rates the same on HELOCs as they are on other forms of credit? Typically, no. If you're carrying a balance, typically your credit card interest rate is going to be much higher than your HELOC interest rate. Good point. Yeah. All right. What do people do with that? They bought stuff. They use the money to buy stuff. Now, in the article that you read, the conclusion that they use the money to buy stuff is not a direct conclusion, it's by process of elimination. So in Table 6, not a very well formatted table, but this is what Table 6 in the article is telling you. Panel A, they looked at whether or not housing price growth, so how fast housing prices went up. They looked at whether or not that was linked to the likelihood of moving. And the only way they could measure moving, because the source of their data, was whether you moved to a new zip code. Not perfect, right? There's a lot of, like if you bought one house in El Cerrito and sold it and bought another one in El Cerrito, you're still in 94530. But it gets people who move from one zip code to another. And they find that the rise in housing prices does not tell us anything about whether or not people move from one zip code to another. So it does not seem that people are using this home equity money in order to move up to get a better house. They're not using it to come up with a down payment to buy a better house. Second thing, panel B, they look to see whether or not the rise in housing prices, whether that was associated with buying a second home. Maybe people are taking out HELOCs in order to buy a second home. They're going to buy a place up at Tahoe, right? They're going to buy a place on the beach they can go to on the weekends. Nope, didn't get any of that. So they didn't get any statistical significance for whether or not taking out a second mortgage, which is what you need to do if you bought a vacation home, with taking out a second mortgage and how that was related to how fast housing prices were rising. Third possibility, well, maybe people aren't moving, maybe they're not buying second homes, maybe they're paying off their credit card balances. Nope, didn't get anything from that. There wasn't any correlation between the increase in housing prices and whether people are paying off their credit card balances. So it does not appear that people are taking out these home equity lines of credit to move, to buy a second home, or to pay off their credit cards. It's very unlikely that people are taking out home equity just to sit and look at it, right? You're not going to take $20,000 out of your home equity line of credit just to sort of put it in the frame and look at it on the wall. So what's left? If people aren't buying second homes, if they're not moving, if they're not paying off credit cards, what are they doing? The only things that are left are home improvements, which would be recorded under investment spending, under residential investment spending, or investment in residential structures, or consumption spending. People are using that home equity line of credit to buy stuff. They're either they're remodeling their kitchen, it's all that granite countertop, or they're going shopping. Maybe they're paying tuition fees, maybe they're going to Europe, maybe they're getting a new car, they're going shopping, they're doing consumption spending. The other article that I didn't assign, that I attached to the handout on Thursday, that is in the reader for 134, so those of you who are doing those classes at once had to read that one anyway. That one looks at what happens to spending and to employment in counties in which there was a lot of use of these home equity lines of credit. They look at, in the graph I'm going to show you, they distinguish between high household debt counties. So now the data are on the county level. So they're going to compare Marin County, Alameda County, Contra Costa County, and so on. So they have county level data. They're going to take all the counties in the United States, they're going to put them into 10 bins. So deciles means there's 10 bins. And then they're going to take the top bin, and the top bin is the counties with the top 10% of increases in, let me